We were having dinner with my parents over the weekend, and we got talking about what else? Mortgage interest rates. And the mortgage rates have been coming down, and my dad has been seeing a lot of things in the mail about refinancing in the low 2% range. And it brought up the discussion of the differences between FHA loans and conventional loans. And in today's Mortgage Real Talk, we're going to take you through a total cost analysis that will help you save money on looking at whether or not you should do a conventional loan or an FHA loan, and why you want to always lean to conventional loans first, even if it's a higher rate. Hi, I'm David from the Cramm Group here at Home Mortgage Alliance. And this total cost analysis that you see right here has the same purchase price for both conventional and FHA loans. The conventional loan is 3% down. The FHA loan is 3.5% down. So those of you with really quick eagle eyes just notice that even though you're putting more down with an FHA loan, you actually end up with a higher starting loan amount. And that's because the FHA loan has additional fees involved. So there's what's called upfront mortgage insurance. That upfront mortgage insurance typically gets built into the amount of the loan. And at 1.75% of the amount of the loan, that's a pretty hefty fee. And so conventional has no upfront mortgage insurance. Further, when you start to look at the total cost then over time, FHA even gets more expensive. But let's cover that here in just a minute. So the interest rate on this conventional loan that I priced out was at a 760 credit score and putting 3% down. Single family house here in Denver, Colorado. So 2.875% was the rate I was able to get. By contrast, same deal with the FHA loan, we're at a little lower rate, 2.25. But when we start to add in some of those upfront fees, now all of a sudden you start to see some of the additional costs being carried in what's called the annual percentage rate. So the annual percentage rate for a conventional loan is about 3% on this example. On an FHA loan, by comparison, again, we went from a 2.25% rate to the APR being 3.7. So all of a sudden, you start to see the cost of doing anything, buying or refinancing with an FHA loan is more expensive. You say, well, then what's the difference in the payment? Well, the payment between the two is virtually the same because, again, you got a lower interest rate on that FHA loan. However, you have also a lower mortgage insurance cost on your conventional loan. So let's take a look at that and just talk about that just for a minute. So the monthly mortgage insurance on this that I priced out was $183 a month for a conventional loan. That's based upon their credit score and their amount down. On FHA, however, it's only based upon what you put down. So if you're putting only 3.5% down, regardless of your credit, so 760 being a good score, you pay the same mortgage insurance amount at that score as you would for a 620 credit score. So you can see how you have a $307 cost for that same mortgage insurance. Now this monthly mortgage insurance on FHA stays for the life of the loan. So unless you refinance, that is going to be baked in there forever. On a conventional loan, that $183 a month can come off when you have 20% equity in your home, having been there at least 2 years, and you apply to the mortgage servicer to have that come off. So the mortgage values, the home value is going up, your mortgage balance is going down. As that gets to 20%, you've now saved yourself an additional $183 in the payment. So you're saving upfront fees and you're saving that monthly mortgage insurance is cheaper and the monthly mortgage insurance can go away. Now, what does that look like in terms of the total time being in the house? Because ultimately that's what you want. You want to save the most that you can for the period of time you plan on being in the house. $6,880 is how much you would save in this example, financing on a conventional loan versus an FHA, even though the rate is less over the first 5 years of the loan. Over 30 years on the loan, you'd save yourself from $222,000 to $284,000, or $62,000 in interest over the 30-year time frame. Now, I'm not saying FHA loans are bad loans, because they're not. A lot of people end up in FHA loans. They qualify a broader basket of people, a greater range of credit scores, higher debt to income. We have some other videos which go through that. But when you are comparing against conventional and FHA, and when you're getting things in the mail, like my dad, you definitely want to look at the fine print, because even though the rate seems great, it may not always be the best deal for you. If you'd like us to run a total cost analysis that allows you to look at some differences between different loan types, let us know. We're happy to do it free of charge, because we want you to be in the best loan regardless of your situation. Thank you for watching. Hope you have a great afternoon.